The following program has been pre-recorded and is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady from EG Tax, and today we're going to be chewing up text messages and emails that you send in, and I think you'll find it interesting because we really get into depth, and I think you'll find that listening, there's all kinds of little thought processes that you have to go through while you're doing your taxes. And obviously, we want to make sure that you don't overpay your taxes. And we want to make sure that we've done the best at making sure that your finances aren't negatively impacted because of taxes or making a bad decision. And of course, I'm joined in studio with Chris Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher. Okay, so we got emails and texts.
We do,
right?
we do. But you know what? I want to start off, too, by saying, if you like helping people, if you like numbers, our tax school is starting soon.
That's true.
Call our office. And
we really, if you're somebody that likes law, because our computers do the computations. Right. But if you like law and helping people, and you'd like to, we have a 4-year program, doesn't cost, there's no charge for the education, and you might find that you have a great career.
Right. It's a great 3-month job. 3 months, yeah. It's a great 3-month job. It's right. During the winter, so if you're not a skier or anything like that, and you get to work inside
right.
and
and meet nice people.
And meet great people.
Yep. So you just have to go to our website at egtax.com, and we have registration forms online that you can fill out.
Right.
It actually starts in the fall, but we especially want to let people know that we are offering that so that you can kind of plan when you're going your luncheons and things this summer. You can say, I'm going to go to EG Tax School. Get a friend to come.
Right? Yep.
All right. What do we got here?
Okay. I'm going to start off with a spicy email.
A spicy email?
A spicy email. Barb writes in, if this is her real name. My husband refuses to file jointly with me. He lives with his girlfriend, and I have the 3 kids. And then the refund money and need the refund money. I'm a waitress. I only make $18,000 and he pays nothing since we never went to court. I do have food stamps and he makes the house payment. He says he's coming back, but he's been gone since March of 2022. How can I make him file with me?
Well, honey, I mean, I feel very bad for her, but the truth is there's a loophole in the law that she fits right into, doesn't she?
Right.
And so in this situation where your spouse has been gone for the last 6 months out of your home and you're maintaining a household for a minor child and they're your dependents and your income is lower then for tax purposes, you're considered single and therefore head of the household. So you will not only get the child tax credit, the additional child tax credit, and then earned income credit. So you're going to get thousands of dollars back that you didn't pay in. And quite frankly, your ex-husband, too bad, too sad, or he's not an ex, living with whoever, he's going to have to file married filing separately when he finally gets around to filing. You will be very happy.
Oh my gosh, she will be extremely happy.
Because at $18,000, that's about the top of the EIC.
Yeah, she's going to get about $6,500 earned income credit.
And then on the state.
And the state, so that's another $25,000.
Right.
So that's $9,000. Then the additional child tax credit, that's $4,500. Mm-hmm. New York State, that's if they're 4 and 16, would be another $1,000 basically. So that's another total 55 plus the not, so that's about $15,000.
Yeah. What a wonderful thing for her.
Yeah. And so don't file with him.
And I'm going to
kick
tell
his
you,
butt to the curb.
if you have to understand that when they write tax law, they definitely lean. The tax law leans favorably to people that have children and people that are lower income. So fortunately for you, even though you're still married, in this situation, the IRS says he was gone the last 6 months. You are head of the household, even though he's making the house payment.
Right. And you're head of household because you have the children.
That's right, the children.
Right. If you move out and he keeps the children, you would be married
Separately.
Married separate.
Right, and you wouldn't get all those benefits.
No.
But this is a loophole in the law which really benefits you.
Right.
And so file.
Yes.
And if you wait for 3 years, you lose those that earned income credits. So you want to make sure you get it done.
Right. Yep. And then, well, here's another married one. This is from Lily. I just got married last year, and when we filed our return, our federal refund got seized for my husband's back taxes. Am I stuck paying his taxes? Do I have to file joint?
All right, so I got good news and bad news. Good news on the federal, bad news on the state, right? Because on the federal, she can file an innocent spouse, right?
Right.
But on the state, it's too late because they already seized her
Oh,
refund,
after 30 days.
right?
Yep.
So the good news is
She can go back and amend and do the injured spouse.
injured spouse.
Yep. And they will go back and adjust it and give you back your part of the refund.
Right. So if you are married to a person that has back child support, back
Student
loans, back taxes, and there's a levy or a lien against their refund, then when you can get the benefit of filing the joint return, but you would file the person that isn't obligated to pay the debt would file injured spouse on the federal. On the state, you'd file as non-obligated spouse. The state of New York, however, will not allow you to go back and amend the return once 30 days has lapsed. So in this case, we can help you with the federal, but not New York State.
Right. So, but going forward, you can always do the injured spouse.
And that's the way you should file
right.
From now on. Or married filing separately, but then you end up not getting the child tax credit and some of the other. If he itemizes, you have to itemize. So you do the whichever is better for you. But the thing that most people do is if they want to file a joint return, injured spouse for the person that isn't obligated on the debt, so that you get your refund for your share. If you're listening and that's happened to you, we can fix it up to 3 years after the due date of the return.
Right. And then you know what? Also, if you've been married and all of a sudden you see a bill from the IRS come in and they threaten to garnish you, right? And you're like, why am I getting this garnishment? I always thought we had refunds coming. And lo and behold, the husband will keep beating up on men. Why not? The husband was lying on the tax return, lying to you.
That's a different exclusion. No.
Right. I mean, and I just want to put that out there.
Well, actually, we're going to talk about this right after the break, and Chris is going to give you another thing for those cheating husbands, right? On the other side of the break. So hang on. I'm Esther Gullius, the tax lady. We'll be right back. Hi, I'm Esther Gullius, the tax lady. To us, your family, and I'm joined in studio. We're doing your emails and texts today, so don't call in. But Chris, you had wetted everyone's whistle. That's it. And so, what is it that you would also be able to use if you had a deadbeat
Right.
spouse?
We just talked about the injured spouse, and that's where you go into a marriage, and the prior spouse owes back taxes, back child support, back student loans. What I'm talking about is where one spouse lies on the tax return. Maybe they're self-employed and there was an audit involved and you ended up owing $100,000. He just forged your name.
Your signature.
Your signature. He forced you to sign. You can file what's called an innocent spouse to take your name off of that liability. You have to prove it, with the false signatures. You would have to prove that that wasn't your signature. Maybe there's a domestic violence involved where you have police reports. You can show the police reports where he was threatening. He did, he could have beat you up. And we've seen that.
Right. And the thing is, with an innocent spouse, it also, maybe this is another situation where the spouse is self-employed and he reported $100,000, but he gets audited and it was actually $500,000.
Yep.
Now there's this gigantic liability. Whenever you file a joint return, you're equally responsible. If he's a schnook and he did that, you're equally responsible for the additional taxes due because you filed a joint return, unless he forged your signature. You had no idea. You thought it was absolutely correct. That you had no idea that he was cheating. So in that situation, you would be an innocent spouse as opposed to an injured spouse.
Right. So I just wanted to.
And we've
seen that.
I have not had a lot in my career, but I can think of one lovely lady who was working at a minimum wage job. Her husband had left her, and he was filing tax returns all those years, and she had no idea. And so we were able to not only get her off on an innocent spouse, but we proved that he had forged the signatures so that she was just even less obligated. The IRS was wonderful to work with.
Right. And I also want to say, if you get divorced and you guys owe the IRS money, and in the divorce decree it says he or she is responsible for the IRS debt, the IRS doesn't care what the divorce decree states. If that person stops paying, they're going to come back after you. And that could be 6 years later.
Right, absolutely.
I mean, so you got to stay on top of...
kind of going on along with this whole thing about getting a divorce. When you are in a divorce proceeding, give us a call so we can we'll tell you about alimony being taxable, child support, whether it's deductible, all these things. Many people, you can have a great divorce attorney who's not up on federal tax law and doesn't know that you need to have the 8332 signed and things of that nature. We'll be very happy to help you, and there's no charge.
Right. Definitely.
Okay. So what else we got here?
Okay. I'm considering starting a new company. Should I be a DBA, an LLC, or a corporation? It's very confusing. I'm going to do a party planning and tent and chair rental business. So what should he be or she?
Well, I know we've never really talked about this, but for me, I always think that the least you should be in starting a new business would be an LLC, because it's not expensive. It's a sole proprietor. I'm assuming that it's not a partnership.
Probably. Right.
It's sole proprietorship. Then the only thing, if God forbid somebody trips on one of your tables at an event and sues you because they broke their neck, all they can take is the assets from the business, provided you weren't negligent. And so it protects your other assets. We live in a very litigious society. So one of the beautiful things about these other forms of taxes is they're all to protect your other assets. And so I would say that you'd start off as an LLC. As your business grows and becomes successful, you might want to, at that point in time, move to a corporation.
Right. Do the planning. I'm glad this person emailed before they did it so we could advise them on the best road for them.
But if they're just a Schedule C, I mean,
Right.
But you can just be, you don't have to be an LLC. You can just be a Schedule C, hang out your shingle, and have people rent. And you may never, ever have any problem. But it's like, just for that extra layer of protection, it's like a free insurance policy because you're protecting your assets. The LLC is a nice thing to have, but you could be just a sole proprietorship.
Right. And I always ask my clients when they ask me this is, well, can you be sued in what you're going to be doing? And they look at me and I go, well, that's the big thing, because if you're going to be just a consultant, and I'm not saying consultant is bad, but there's a lot of people.
In other words, there's not a lot of bad moving parts. Being a
Right. You
consultant.
retire from your job, and your
Right.
company says, "We want you back, and we're going to pay you as a 1099 instead of." So you're not going to be getting sued.
Right.
So
Probably.
So there, I would say just a DBA. But if it's, you're dealing with the public, I would definitely do some type of protection, whether it be an LLC or a corporation, just
Right.
to keep that bubble of protection around your personal assets.
Right.
Even rental property.
Yes, especially rental property.
You got
I mean, a lot of times you think, how can something as passive as rental property be a problem? Well, my gosh, that's where people live. I mean, they could get drunk, fall down the stairs, say that you didn't have the stairs done properly. So you can do an LLC on a rental
right
for protection, and you would do one on each one.
Yeah.
On each rental that you have.
And that would get very confusing. But I mean, I know I have a client that has like 25 rentals. I know you have one that has like 40,
Right.
and and we advise them, and if they take our wisdom,
Right.
but the thing is too, with somebody that is in the rental game like that's basically their only source of income, they may want to consider doing a corporation
And putting the rentals into the corporation.
right, to get a paycheck,
Right.
because then that opens up retirement plans and opens up QBI, opens up Social Security for retirement. I mean, there's a lot you can do, because rentals isn't, even though it is a business,
It's passive.
it's passive. So that goes on a Schedule E, not a Schedule C.
And the benefit to the rental owner is that they don't have to pay FICA. I mean, it's a benefit now, but when they're older, they haven't had done 40 quarters, they won't get Social Security.
Or Medicare.
Or Medicare, right.
Well, I know we have a
But
client.
then if they're married and their spouse was working, they
Right,
can
if they're
piggyback
married.
off their spouse.
Yes. But I know we have a client, he's single, and that's all he's done was rental properties. And we told him, go get a job.
Right.
What? Well, you're complaining you don't have Medicare and you have to pay all this money for health insurance.
And let's face it, I know we're kind of getting off the track here, but let's say that you have had rental property for 30 years and you haven't paid into Social Security, and now you maybe are 10 years before retirement. If you worked for the next 10 years at a job, even if it's a lower income job, you're paying into Social Security. Yeah. And if you're single, then you don't have to piggyback off your spouse, where you get 50%. You would actually qualify for Social Security. And if you're somebody that has already maybe retired and you don't get it because you still needed another 3 years of 12 quarters, get a part-time job.
Right.
Walmart, you work at McDonald's, you'll get the money.
Yeah, I was going to say, because, when you
It
were
really
a teenager, those years you worked at McDonald's and Burger King
Right.
and the shoe store, that all counts. So you may only need 4 more quarters.
Right. And I work with my clients all the time, say, how many quarters do you need to collect? Well, I need like 3 years. Gosh, but all I'm going to do, I don't want to work for $14 an hour. But think about the future benefit you're going to
Right.
get, even if it's $800 a month. That's $9,600 a year because you did that little minimum wage job.
Right. Exactly.
Okay.
So,
What else we got here?
We have. Well, I'll start reading this one, and we can get to it after the news. But
Yep.
I'm starting a daycare business in my home.
Oh, yeah. We're going to have to talk after the news.
I'll be taking care of 3 children on weekdays. Can I write off my home and other expenses? How do I do that?
Okay. Well, that's really, I'll start it here and we'll finish it on the other side of the news. When you are bringing the children into your home as a daycare provider, then your home, since you can't really tie them to the chair and children are very mobile, your entire house becomes a tax write-off, and we're going to talk about that on the other side after the news. We'll talk about all those things after the news. So I'm Esther Gullius, the tax lady from EG Tax. We're going to take a short break for the news. We'll be right back. Hi, I'm Esther Gullius, the tax lady from EG Tax. To us, your family, and we're talking about being self-employed as a daycare provider. So, and I was saying, the little kids, you can't just say you can only go in the living room. I mean, they go wherever they want. They're children. So you end up being able to take a percentage of your property taxes, utilities, insurance,
Upkeep.
repairs and maintenance, right?
Yep.
Mortgage interest, real estate taxes, depreciation on the asset, multiplied by the number of hours that you have, actually, the number of hours that you take care of the children versus the entire year. And so it might be 30% of all those expenses that you're able to take as an in-home daycare provider. In addition to that, what else can they take?
Oh, all your expenses, your food for the children.
Right. And there
your
is
toys.
a chart figure,
Yep.
right? So it's like a safe harbor. You can look at and say, this is how much breakfast is, this is how much snacks are, this is how much you can claim for lunch, this is for dinner. And it's right there in a chart, so you don't have to keep track of everything.
Right. Exactly. I mean, but then you get your toys, your if you take them on field trips, your mileage, picking up supplies, taking them places. Maybe you pick them up and take them to your house. Then maybe
Cleaning your house.
Supplies.
I mean, let's face it.
Yeah.
Yep.
Also, we just talked about, being a corporation because of a liability. Hopefully you have
That's for
insurance,
sure. Yep.
an extra
For
insurance
sure,
policy.
I would do an LLC for that. And I know the state of New York comes in and makes sure everything. So there's education.
Yep.
Right? Your cell phone, advertising.
Maybe diapers
Right.
and wipes and all that fun stuff.
Whatever it costs that's ordinary and necessary for you to have this business, that's what's going to be deductible, as well as the portion of your home used for the kids.
Your cell phone, because that's how the parents get a hold of you. How about your internet? Because, let's face it, kids are very electronic savvy, and you may use your internet for
and
them
cable.
and teaching.
Right, because you get a TV in the TV room where the kids are. I mean, all of that's deductible. So let's say she starts off with $40,000 worth of income. After she has all of her expenses, she might only end up with $10,000 that she pays taxes on. On that $10,000, she'll pay FICA of 15.3%,
Yep.
and she'll pay income taxes. If this is her only source of income, she won't pay much in taxes at all.
No, because all the expenses bring it down. So whatever, if she's single, under $12,500 some odd dollars, there is no income tax. She gets hit with self-employment tax, but
which would be around $1,500.
Yeah.
And the state of New York, she would pay
very
little as well.
Yeah.
The thing is, she also can put money into an IRA and an SCP if she wanted. She could do an IRA for sure.
But $10,000, she's entitled to a single earned income credit to help bring that down.
Right.
So
she would do very well. So the thing is, we have these wonderful record books that are available in our office. If you wanted to stop in, it's a business record book to keep track of all of your income and all of your expenses. And I know a lot of people say, well, I'm going to use QuickBooks. The trouble with QuickBooks is you got to sit down and do it. The lovely thing about this bookkeeping book, it's you can bring it with you when you go to the store and fill it in. So
right, and one other thing, talking about daycare, how many clients do you have where you say, who watches little Susie and little Johnny? Oh, my mom does, but we're not going to worry about that. Well, we just talked about all these expenses.
Right.
You may pay your mom $10,000, but how much money do you think Grandma spends
on the kids?
On the kids,
right? And I guess it'd have to be ordinary and necessary, right? So if she's buying them gold lame dresses, that wouldn't work. But the credit can be up to 30% of what you're paying for daycare on your tax return. So then you think about if you gave mom $10,000 to watch your kids, she still gets all those same expenses. She would maybe obviously not be able to take a loss because this is probably not a business, right? For her. But you'd make out by, let's say, anywhere from $2,000 to $3,000 in tax savings. She would pay no taxes, probably.
Yep.
So it's just good tax planning.
Right.
You would never let me steal $2,000 from you, but I watch people do this all the time. They go, oh, no, I don't want to turn in my mom. I don't want to have my mom be mad. I'm so thankful that they're watching my kid. But the truth is, what I'll do is I'll do the parents' return and do the daycare credit. And then I do the grandparents' return, and I do the Schedule C, eliminating the income in most cases. And it's a win-win situation. I don't know why it is, but people think you're not supposed to have your daycare provider claim the income, which is absurd. You got to claim the income.
Right. Again, here you're paying the taxes for somebody else.
Right. Absolutely.
But think about what it was for 2021. When it was big, it was a big that person
thing.
Would have saved $5,000 on the federal
refundable.
Refundable. And here they didn't want to have.
Yeah, so look if you in 2021 were protecting your daycare provider and you didn't claim it, you might have a $5,000 refund coming.
Oh yeah, up to $8,000 basically.
Right. So and you still year is still open. So, and you as a daycare provider, if you're listening, you should claim the income. Absolutely. You could set up your own pension plan. People are so afraid, oh my gosh, I'm going to have to pay taxes. Well, if you do it the right way, it all works out.
Right. Yep. Okay. Well, let's go to Nathan. My tenants did not pay me rent for 4 months last year. When I took them to the court, the judge gave them another 3 months before they could get evicted. Do I get to claim all my expenses, or am I limited because I only received 3 months of rent this year?
That's a really good question.
Yeah.
Right? I mean, as long as he has an income, the big umbrella is, are you trying to make money?
Right.
If you're trying to make money, it's available for rent. The people aren't paying you. You've done everything that you can do to get these people to pay. Yeah, the expenses are deductible.
Right.
But then here's the caveat. Did you make more than $100,000? Did you make more than $150,000? Because if your income exceeds $100,000, and let's say that in this particular year you end up with a $20,000 loss on your Schedule E, but your income is $160,000, they're not going to allow you. Is it deductible? Yes. Are you going to be able to take it on your tax return? Not now.
No, but I would still take all the expenses.
Oh, my gosh, yeah.
I don't want people to think how you were talking, not to do anything with it.
And that's because, can you take it? No, because your income's over $150,000. Those losses are suspended.
Right.
And so they're just like sitting there until you get rid of that property.
Or your income drops.
Or your income drops. And then it all comes up and can save you a ton.
Right. Especially with rental property. When you sell it, people don't realize rentals are great every year you have them because normally you have losses.
Because of the depreciation.
But because of the depreciation, when you go to sell it, you get bit in the butt.
Right. Or unless you have suspended losses.
Right.
Or you're doing a
1031
exchange.
Right. And that's because all that depreciation you took actually reduces your cost of the property. So say you bought a house for $100,000, keeping it simple. You sold it
for $200,000.
What?
For
$200,000, but you sold it 30 years later. The house was all written off because that's what depreciation does. It brings down that $100,000 every year. So now it's fully depreciated. You sell it for $200,000. You have a gain of
$200,000. Right.
And people are like, wait, no.
Right. And the federal government cuts you some slack because it's a capital asset. The state of New York does not. So at that point in time, if it's after the fact and you come in to visit us, then we're going to just hit you over the head with the big tax bill. However, if it's before the end of the year that you sold it and you do a 1031 exchange where you can exchange it from rental property to rental property. Now, it doesn't have to be rental property that you're managing. It can be a limited partnership that you got involved in, and they might be renting to Family Dollar and they just send you the money every month. You don't pay taxes on that until you get out of that partnership.
Right. And then going back to the original question here.
Oh, was there an original question?
Well, here he tried to make the money.
Right.
So, yes, but if it was your sibling and they lost their job and you decided, you know what, don't pay me. When you get another job, then we'll work something out. Well, then you're not running it like a business.
Right.
So then you cannot take all those expenses.
And I have to say, some of my wonderful clients who I love to death, they have rental properties and maybe they're in a duplex, and Laura has lived upstairs for 25 years and the rent is $500 a month, but everybody in the neighborhood, it's $1,200. You got to raise Laura's rent or you don't get to take the deductions.
Yeah.
Because whether it's a friend or family, you have to have that profit motive in order to take the expenses.
Yeah, and I don't want to scare people right now, but with the rents going up as crazy as they are, I could see the IRS doing audits on Schedule E's again.
Oh, for sure.
Because where it was okay for $500 a month, because of COVID, I don't know, the rents just went crazy through the roof. Now it's $1,500. So if you're only claiming $6,000 where you should be claiming $18,000, I could see them saying you're not doing it like a business.
Oh my gosh, I guess. And that's part of what we want people to see is that we kind of had this period of time where they couldn't audit you. Well, now with this new group of IRS agents, if they audit you and you are not trying to make money and you're cutting everybody some slack, it's not going to let you deduct all the expenses. I'm Esther Gullius, the tax lady from EG Tax. We are going to take a short break. We'll be back on the other side with your questions and texts. I'm Esther Gullius, the tax lady from EG Tax. We're doing texts and emails this week. And I got Chris Fabian with me. Chris, what else we got here?
We got Bill and Sandy writes in, Esther, I know I can use the sales tax on a new car, but can I use the sales tax on our new motorhome? We paid over $75,000 for it.
Yeah, I mean, here's the good news and the bad news. The good news is it deductible? Yep. Is it going to probably save you any money? Probably not, because all of those taxes, which are an itemized deduction, are limited to $10,000.
Right.
So if you have property taxes and New York State income taxes, and maybe your income taxes were 3, but your sales taxes are 8, you're capped out at 10 anyway. So
right.
It might save you something, but not what you think.
Well,
Yep.
on the taxes, Where else might they be able to use a deduction for a motorhome?
On the state.
How about as interest if you have a loan?
Oh, you mean a second
As a second home.
Right, second home interest.
Right. And I mean, I'm not sure what but I'm sure those interest rates are going up.
That's for sure. Everything's going up.
You know, so the interest you pay on your loan, and let's face it, some of these motorhomes you see are costing $400,000.
Right. That they only had $70,000. It was reasonable.
Yeah. But they could be paying $4,000 a year on a motorhome.
Yep, in interest.
In interest.
And so that would make you qualify possibly as an itemized deduction.
Right.
So that's something you want to look at.
So, yeah, it just may have opened. Plus, you said New York State for the interest.
Right.
Where you might
on
not
both
be.
The interest and the sales tax.
Right. But where you may not be able to itemize on the federal,
you might be able
to itemize on the state. So it could save you something.
Right.
It'll
be interesting because in 2024, and we're 2023 now, these changes that took place under the Trump administration are all kind of supposed to go away. So that ought to be interesting. We will keep everybody up to snuff on that.
I mean, and that's the thing. No one's talking about that.
Yep.
No one. I mean, and that was the big election point way back when. Was the tax cuts that he wanted to do.
Right.
And now, are they going to keep? And that's why I tell my clients, we don't know what's going to happen in 2 years. We don't know what either party, if they're going to keep them or if they're going to bring them back to the old way, or if they're going to do a merger, and come up with a brand new way.
Yep.
So stay tuned.
I know I'm really looking forward to it.
Hey, job security.
Yeah. Okay, what do we got?
Okay. We're selling our house and moving to Tennessee. In order to accomplish this, we have to sell our house. We are looking to make about $240,000 profit. How much do we have to keep aside for taxes? Blake.
Well, I mean, it all depends on if you lived there for the last 2 years as your personal residence. And you're saying we, so I'm assuming that it's a joint return.
Right.
I'm assuming. And so the beautiful thing is, and if everybody, people love loopholes, this loophole is remarkable. The first $500,000 of gain and your personal residence when you're filing a joint return is tax-free every 2 years. So Blake could sell the house, pay no taxes, go to North Carolina? Is that right? Tennessee. I knew it was down south. And in 2 years, sell that house and make a profit and tax-free. And in 2 years, sell the next house that he lives in tax-free. It is a great way to make money tax-free.
Right. And say he didn't live there for 2 years.
Well, then that's a problem.
Possibly. Why is he moving? Was it for a job?
So there you mean special circumstances.
There's always gray area
right.
in taxes, and that's, maybe it was for his job.
Right.
He got a new job, and so he had to move to Tennessee. So then he gets the exclusion, not the full exclusion, but you have to prorate it over the time that he lived there. So if he lived there a year, married couple, instead of $500,000 would get a $250,000 exclusion.
So that would still cover them.
It would still cover it.
Right.
So I think you're okay.
Some of these special circumstances might be health, job, if your spouse went into a nursing home, those kind of things. Maybe you lost your job in Buffalo, you can't afford to live there. So all those special circumstances actually still let you deduct some substantial gain.
Yep.
Okay, what else we got?
Okay. Tax lady. My daughter is going to college, and she is receiving a lot of scholarships. Is there something we need to be aware of?
Yep. And if she's getting more scholarships than the tuition, then it's not good. I mean, it's good, but it's not good. It ends up being, it's a wonderful thing. I had one client one time where, 3 children were at a very, very, very expensive school, and the parent was at that same school, and their scholarships between the 4 of them were like $160,000. Okay, but the tuition wasn't that high, and so each one of them ended up with excess scholarships of like $10,000 apiece. So it's like $40,000 extra. And did it cost them $4,000 in taxes? Yes, it did. But I said to them, you got $160,000 and it's costing you nothing, very little. So you got to put it into perspective. And in this situation, if there's excess scholarships over the cost of the tuition, it's taxable.
And notice Esther only said tuition. Scholarships don't count for room and board. That is taxable income.
Right.
And unfortunately too, how about this? It doesn't say how old she is, but excess scholarships is unearned income.
Right.
Which then could lead to
kiddie tax.
Yes.
If the parents are claiming them.
So
sometimes it's better for the parents not to claim them.
Right. So
Let's kind of linger about kiddie tax. I think a lot of people don't know
understand.
About it. And I'm not even sure that the IRS goes after those people with kiddie tax. Have you seen any kiddie tax adjustments where the parents didn't claim the excess scholarship? I mean, during COVID, I haven't seen it.
Yeah. You would think that would just be a letter. But, no, I mean, I know I prepare all the kiddie tax returns that I have to. I mean, we're not saying don't do it.
No, but I'm just saying I think that there was this whole COVID malaise where I don't think that they had the staff to maybe go after people and even ask the question.
Right.
And they probably said, we just want to process the returns.
Right. And what is unearned income for kiddie tax? Because people used to think that was just interest and dividends.
Right. Unemployment.
Yeah.
Excess scholarships.
Yep.
Right.
Yeah, all that counts. Gambling even is unearned income.
Right. And so the bottom line is if you're claiming your child as a dependent and they have unearned income, then they are a possible candidate for kiddie tax, which basically, to put it simply, is they're going to make the kid pay taxes at the parent's highest rate.
Right. So if mom and dad make $200,000, so they're in the 24% bracket, and the child only has $5,000 of unearned income, they're going to pay 22% or 24% on that $5,000 instead of 7%.
Right. What about their standard deduction?
They don't. They get $400.
Right. They basically lose their standard deduction.
I think.
So it was meant to, because back in the day when interest rates were 18%, and they're going up now anyway. Back in the day, parents would put money in their kids' Social Security number so that the kids would pay the taxes or not pay the taxes because the kids were in such a low tax bracket. Well, then they came up with this kiddie tax that says, oh, yeah, you guys think you're so smart. We're going to make the kids pay at your rate, so ha, 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 you didn't make out at all.
And that used to be like up to age 3. And then they moved it to age 5.
Right.
Then they moved it to age 12. Now, as long as the child's in school, it's all the way up to age 23 if you're claiming them.
Right.
So they are making it more and more accessible, I guess would be the word. Probable. Punitive.
Yeah. So that if your kid has unearned income and you're claiming them as now, if the kid doesn't get claimed on your return, then the whole kiddie tax goes away, and of course all you're saving might be just the $500, right?
Right.
Especially if they have scholarships.
Yeah.
Because you're not getting
the college
education
credits.
Right.
Yep.
Okay, we have something to round out the end of the show with, Chris?
Really fast one? Okay. At what age do I have to stop filing tax returns?
That's an easy one. That's an easy one. If you got the income, you keep paying taxes.
Yeah, I did a tax return for a 99-year-old this year. Because their RMD was quite large.
Right, I'm sure.
Yeah.
I'm sure.
So unfortunately there is no age requirement.
Yeah,
it's
it's
all
not like,
income based.
yay, you're 95, you don't get to pay taxes. That's not the case. If you have the taxable income, then you have to file a tax return.
Right.
And, usually as people age, though, many times they have health things
Yep.
that help to mitigate the taxes. So you end up with the income on one side and the medical expense on the other. Well, I'm Esther Gullius, the tax lady from EG Tax. If you need any tax questions answered, you can go to our website at egtax.com. Until next week, I'm Esther Gullius with Christopher Fabian. Thanks for listening. Have a great week. Bye-bye.